You are welcome, everyone. I did save the market. I might look funny while waving the checkered flag, but look at me waving my dick in bears' faces. Oh, bears, I know what you said. Qualcomm guided down. The phone sales were gonna suck, and as a result, Apple stock was gonna tank. How wrong you were! It makes me giddy. You said all sorts of vile things about our valuation, about our Apple being laggards in technology. Bitch, I am a gay man from Alabama. I have tougher skin than whatever your smooth brains can dish out. Watch me skull fuck the big tech shorts now. Lastly, you all forget. Apple is not a technology company. Apple is not a hardware company. Are you still living in the 1990s? Apple is a services company. And just wait till I announce how much money we made from our savings accounts that you all poured billions of your life savings in for a mere 4% interest. I can go flip that for Treasury bills, giving me almost 6%. 2% in free cash, baby, with no risk to me. That's all on Goldman. Yeah, the SEC can't do shit about Apple's growing monopoly. I would say be like Warren Buffett. Even he bought Apple at 20 profit to earnings ratio. Anyways, fuck you.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. US stocks closed mixed on Friday as Treasury yields ripped higher. Markets logged weekly losses over uncertainty over the Federal Reserve's next move shadowed a robust earnings season. We saw losses in pretty much every sector except for tech or technology related stocks, and it's very simple to trade today. Yields ripped higher, so stocks moved lower except for those going into earnings next week, and the beneficiaries were Nvidia, semiconductors, Microsoft, Apple, Google, Meta, Amazon, Tesla after its earnings yesterday, and that was why tech stocks, semiconductor stocks, and software names did really well. Every other sector was in the red today. Now, apart from the big tech companies, there were some big movers. Capri, shares of the fashion company Crated, down nearly 50% after a judge blocked the parent company Michael Kors from merging with Coach owner Tapestry. Meanwhile, Tapestry jumped more than 15% following the decision, which said the merging parties are close competitors and that a merger would lead to less competition, essentially creating a monopoly in accessible luxury handbags. Very crazy price action right here. Maybe there could be a buying opportunity here. I'll definitely look into it over this weekend. NYCB, New York Community Bancorp, reported earnings. Shares of the regional lender fell 8% Friday afternoon after posting higher loan loss provisions and loan write-offs in the third quarter. It also reported its fourth consecutive quarterly loss of $280 million in the quarter and delayed its goal of turning profitable by a year in 2026. And guys, this literally offers a fresh reminder that commercial real estate problems are not totally in the rear view. In any other circumstance, this stock would be down like 20%. It was only down 8%, which really goes to show how much negative sentiment and how much of this is already priced in. Still a crazy day, but given the results we saw, it should be much worse, meaning that there's probably value and we're probably closer to the lows for NYCB than most people think. We also got earnings from Colgate-Palmolive. The consumer products company slid more than 3% on Friday, down 4.22% for the day, beating third quarter earnings expectations and raising its guidance. However, valuation concerns came into the mix, especially in North America, which makes up 20% of its sales, and there was some weakness in terms of guidance and commentary in that regard, and that's why the stock was down 4%. So, good earnings, forward guidance, and weakness in the American segment not boding well for the overall consumer. But looking at sectors overall, the S&P 500 returned pretty much flat today, down 0.03%, exactly the same move as XLE, the energy sector. The only three sectors that were positive today were the big tech, magnificent seven sectors, communication services, the discretionary space, and the technology sector. Other than that, every other sector was in the red, with financials and utilities really weighing on the market, both down more than 1% each. And really, this is a great way to look at the market today. In every single segment, growth won. Large cap, mid cap, small caps, they gained today. Core was the next best asset class, but still in the red. still saw declines today, and value really got hit on the chin down in the large, mid cap and small cap segments. So if you were in growth, particularly large cap growth, the mega cap names, the tech names, you really did do well today. And all of this was on the back of very solid US data. Durable goods orders came in better than expected. We got negative 0.8%. So durable goods still posting negative losses and still in a recession. However, the consensus was for negative 1%. X-transport actually saw a gain of 0.4% versus the consensus negative 0.1%. Very solid. And X-transport posting back-to-back gains last month and this month. Very, very solid. We also got solid new home sales data. We saw 738,000 new home sales this month. The consensus was 720,000. So great data across the board. And that's why yields rose. When we get better than expected data, the yields are going to rise. The dollar's going to rise. That's going to affect equities, particularly the value and core segment. And that's why we saw value and core down today. And then growth was really rallying today because of earnings next week. A ton of growth stocks report, and that's why we saw a very solid rally in growth names today. All in all, medium term and longer term trends from a breadth perspective look very, very constructive. However, look at the deterioration in the 50-day from last week at the 68% mark to yesterday 54% to today at 50%. If we get one more down day in this market, this is going to fall below the 50% mark, and then the bears have taken the 50-day. The 20-day and 30-day continue to deteriorate, and that's not a good sign. So the bulls need to step up their game right now. Otherwise, we really are going to start capturing these medium-term trends, and that could bring downside flows into the end of the month, into the election period. However, longer-term averages, the 200 and 150 moving day average, the percentage of stocks above those averages still very, very robust, well above the 50% range. Guys, this is a healthy number. So too is this. But shorter-term averages looking really, really dicey at the moment. On the back of the solid housing and durable goods data, yields actually rose significantly. The 2-year, 10-year, and 30-year yield both up. The dollar rose as a result. That happens, guys. When yields rise right now, the dollar's going to rise as well. They are highly correlated assets. However, it didn't really affect commodities. Silver flat, gold up 0.39%. And when we see the dollar rise and gold rise, it really is a sign of unusual market conditions, and it could suggest global economic uncertainty, inflation concerns, as well as maybe geopolitical risk. Equities, guys, the only winner today was the Nasdaq 100 up 0.59%. We know why. The mega caps rallied. However, the S&P 500 was flat. The IWM was down. We're seeing ugly action here in the after hours. Mid caps and the RSP were also down 0.65, 0.47%. So not a pretty day for equities overall, and not a pretty week as well. Almost all of the major equity indices lost this week. The S&P 500 down 0.96%, the RSP more than 2%, the RTY almost 3%. So a very, very rough week, except for the Nasdaq 100. This week, virtually flat, up 0.14% after Tesla's earnings, and it was the most robust sector, and it was just a culmination of earnings this week, Tesla's earnings, and I guess just positioning into quality, especially with rising yields, the election, geopolitical concerns, and all of this meant the Nasdaq 100 was the place to be this week, and every other index got absolutely smashed. But that is the week just passed. What does this mean for the week looking ahead? And if we actually go to the US 500 chart, look at the weekly chart, guys, yes, we did put in an ugly red candle right here. However, we did see buying at the bottom of this weekly red candle, and all in all, things look very, very good for the S&P 500. Higher highs, higher lows, pretty much new all-time highs. Yes, we did notch a new weekly high this week, but we did last week, and that really goes to show the strength in this market. And like we said in last week's video, until the S&P 500 actually breaks this 5400 level to the downside, that's when we would really start to get worried in terms of prolonged downside pressure. We are not seeing that right now, and the bulls are still buying any dips they do get. We saw this week. Look at that wick. Bulls definitely coming and buying the dip in the S&P 500. However, still a red week overall when you look at it in aggregate. Looking at the S&P 500 on a daily chart though, guys, nothing has changed. 57.75 is still the gamma flip, 57.25 is still the put support, and 59.05 is still the call resistance. We've been at these levels for like a week and a half now. We have not moved except for the put resistance, which moved up yesterday. So So we probably are just going to trade and churn at these levels. But I do think next week with earnings, that's really going to determine if we go higher or if we go lower, particularly the mega cap names, Microsoft, Apple, Google, Meta. You really want to watch those names because they are the market movers. And if we get a move like we did with Tesla this week, guys, it's going to be off to the races. Now, I don't think that's going to be the case because sentiment had been a little bit sour. I mean, heading into earnings, if we look at a percentage return basis, Tesla was actually down about 10% on the year. After Elon said 20 to 30% EV growth over the next 12 to 18 months, the stock rallied and pretty much is up now 9% for the year. So it's definitely different when it comes to the other mega cap names. If we actually look at Apple on a percentage return basis year to date going into this earnings, the stock is up 25% for the year. If you look at something like Nvidia, it's even crazier. The stock is up 192% for the year, nearly a double or a triple, depending on how you look at it. Absolutely crazy. Is this the year to date? Yes, 187% year to date. So all in all, guys, a lot of expectations going into these earnings. So we're not going to see a move like we did with Tesla unless we get a huge earnings beat. However, good earnings will be good for the market. And I think what you want to look for when it comes to the mega caps is CapEx spend. We're in a very weird state with earnings, but we'll see how it goes. But looking at the S&P 500, we're still in positive gamma and you still want to buy dips as they come. We didn't notch a new all-time high this week. However, we're still trading pretty much at all-time highs. And like I said, unless we actually go ahead and break the 5,400 level in the S&P 500, which is this level right here, the trend is still up and there's a lot of space for the bulls to go ahead and buy the dip. And we just buy the dip on even a 1% move to the downside. Look at the wicks right here, okay? That is bulls coming in and taking us higher. The Nasdaq 100, this is called a shooting star doji, however, a green candle on the day, and we did actually go and hit a wick high above those highs. I do think, guys, we probably are going to go and attack these new all-time highs next week, assuming the earnings picture comes in our favor. And then looking at the RTY, we did get into positive gamma ever so slightly, although the bears came in a very big way at the gamma flip. So as a bull, what you want to look for right now is a close above the gamma flip, the 2240 area. If we do get a close above, you want to find consolidation and then we can make the next move higher. Until then, you want to remain agnostic on the Russell 2000. This price action is not constructive. However, as long as we hold the 2190 area, I remain bullish. If we go ahead and actually break that, that's when things get a bit concerning, but I'm not seeing that just yet. And as long as we hold this area, I do expect us to go ahead, recapture the gamma flip and take us higher. This looks very, very constructive despite what yields are doing. However, yields are having a tangible effect on small caps right now. We are starting to see that when yields do rise on the day, small caps are falling significantly and expect that trend to continue, especially if we do get better than expected economic data and yields do rise along with the dollar. However, very constructive price action and I will only probably turn bearish below the 2190 area. We're very close to that. However, I remain bullish until we do. And the gamma flip zones haven't actually moved for the Russell 2000. So very weird. I really did think they would move lower, but they did not. And it just really goes to show how accurate these are. So guys, in the Russell 2000, wait for a close above the 2240 level into next week. The Nasdaq 100, you want to buy the gamma flip. That definitely is the trade right now, especially heading into these earnings. And for the S&P 500, you want to buy the gamma flip. Look to the core resistance 5905, 20,675. And for the RTY, let's just hope we go ahead and retake the gamma flip sometime next week. Looking at the RSP, I think the 176 area, this is where you want to buy. It's not a gamma flip zone. It's just a technical level where we held as resistance right here, used as support, broke to the upside. Below 176, guys, you want to actually look to the 170 area. We used it as resistance somewhat right here, used it as a support zone right here. Resistance turns support, support turns resistance. If we do break below here, this is our next level of support. And I think I will be loading the boat on the RSP if we do get to the 170 area. Diving into sentiment, this is CNN's Fear and Greed Index, and we've officially moved from the 75 zone. We've actually pulled back into the 63 level, still in greed territory. However, we've seen a clear decrease or deceleration in greed sentiment, and that mostly has to do with the market dynamics we've seen lately, yields, the dollar, as well as the macro. That's really dampened sentiment overall. However, we have to look at the big picture, and earnings are still very good, especially in small caps. The Russell 2000 right now is reporting 38.3% earnings growth. The top two sectors, like like the S&P 500, comm services, and the technology space, reporting extremely robust levels of growth, well above 50% in each of thase industries. Something to note though, financials actually seeing negative 3.3% growth. A ton of Russell 2000 companies is actually just like regional banks. So to see the bifurcation in the big banks versus the smaller banks still goes to show some of the economic weakness we are seeing in the overall economic market. And this probably goes to show what we're seeing globally as well. So just something very interesting there. In aggregate, earnings looking very robust. And when we look at the global market, this is the annual change in earnings. You can see earnings are growing when we're in this blue zone. In this red zone, earnings are actually negative or declining. And typically an increase in forward earnings signals a positive outlook for rising equity prices, reflecting expectations of improved company performance in the future. And the majority of these earnings are going to buybacks. Now, the buyback blackout window reopens officially tomorrow, the 25th of October, or today, depending on where you are in the world. And S&P 500 companies have the scope to add approximately $6 billion per day in buybacks every day to close out the year. And that would represent 21% of annual buyback execution. So 1/5 all buybacks are going to happen in the next 2 months. And it's not even really 2 months. It's actually more like 6 weeks of trading. If you look at all the public holidays, Christmas, Thanksgiving, Halloween, New Year's, all of that together, between now and the end of the year, 21% of buybacks need to be executed. And that's $6 billion of stock that companies can take off the market. Just for context, guys, it takes about $50 to $70 billion worth of money to move the equity markets in any one direction. So to add $6 billion on top of that every single day, that's just a tailwind. And that is why Goldman actually increased their price target to 6,000 into the end of the year and 6,300 in the next 12 months. They raised their 12-month price target and their end of year price target, driven by robust earnings per share growth, buybacks, and seasonal tailwinds. Very, very strong. Really interesting to see this type of dynamic. We see earnings growing every single year into 2025-26. Guys, and when earnings are growing and margins are expanding like they are right now, you want to hold equities, particularly cyclicals. Cyclicals have really been the trade you want to own and probably will continue to be the trade. Yes, we have seen defensives outperform this year. However, when you look at it, we've sort of just put in a higher low and we've gone and rocketed back up. If we break these highs in cyclicals versus defensives, that's just going to be more fuel for the fire. Onward and upward, you want to hold cyclicals because that's where the earnings growth is right now. And looking at the macro, we got the IMF's global growth projections. They see emerging market growth in 2024 and 2025 at 4.2%, advanced economies or developed markets at 1.8%, total growth at 3.2% for 2024, 2025, a very robust market. But guys, if you are looking for alpha, definitely look at emerging markets. Definitely a place where you can make some money, but you'll have to contend with the volatility. But looking at the overall macro picture this week, we got a note here from Goldman, and they said global PMI slightly better than expected, new home sales above expectations. They boosted their third quarter GDP tracking to 3.2%. The bottom line, S&P Global PMIs increased in October and was slightly better than expected on net. The underlying composition of the manufacturing PMI was strong, with increases in the output, new orders, and employment components. The underlying composition of the services PMI was mixed to strong as the new business component increased. While the employment component remained unchanged, new home sales increased by more than expected in September. The levels of sales in the prior 3 months were revised down. Following the morning's data, we boosted our third quarter tracking estimate by 0.1 percentage point to 3.2%, and our Q3 domestic final sales forecast by the same amount to 3.1%. So both are really liking the data we're seeing right now. However, that is going to come with risks, and that could be higher yield and a higher dollar, especially if we keep getting this, what is extremely strong economic data. And guys, something else we're seeing right now with regards to yield, while stronger data may forecast higher yields, we are starting starting to see a bit of a divergence in the copper and gold ratio. The copper to gold ratio is often considered a leading indicator for the direction of the 10-year US Treasury yield in most market conditions. As you can see, the copper and gold ratio track each other quite religiously. However, we have seen a divergence lately, meaning one of two things needs to happen. This ratio needs to move to the upside, or yields just have to come down. And I do favor yields actually pulling back, especially because we are in a rate cutting cycle. I think that's the most likely scenario, and markets tend to gravitate towards the most likely scenario. And in our market right now, that's lower yields, lower dollar, higher stocks. And then guys, looking at earnings next week, we have a huge week of earnings, probably the biggest earnings week of the year. To kick things off, guys, looking in order of market cap, we have Apple, Microsoft, Google, Amazon, Meta, Eli Lilly, Visa, ExxonMobil, MasterCard. Huge week, and it just keeps going. AbbVie, Chevron, Merck, AMD, McDonald's, Caterpillar, Amgen, Uber Technologies, Pfizer, Comcast, Booking Holdings, Stryker, ConocoPhillips, and you guys get the plate. We also have some of my holdings reporting too. Paycom Software's reporting, PayPal's reporting. It's going to be a very big week for earnings. I cannot wait, particularly PayPal here reporting on the 29th. Paycom Holdings is actually reporting on the 30th, guys. So Monday, Tuesday, Wednesday next week is going to be a big week of earnings, really going to move the market. And if some of these mega caps report earnings and forward guidance as to what Tesla did, you're really going to see massive moves to the upside and downside in the markets overall. And along with a huge week of earnings, we also have a huge week of data. We get the big employment figures on Wednesday, guys. We get JOLTS. We also get the GDP growth rate quarter-over-quarter revisions. We get the PCE price index, personal income outlays, and personal spending. And then we get non-farms and the unemployment rate on Friday. So a big week of earnings, a big week of data. Really, there's going to be a lot of moving parts next week. Guys, next week is one of those weeks where you just hold the stocks you have and hope for the best. And if you've been following this channel and listening to what I have to say, you don't have to hope, because you do know the best is coming. But next week, we'll take it day by day as it comes. However, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.